Hello and welcome back to the channel. Today we dive into collateralized loan obligations, or CLOs, focusing on CLO equity funds. These funds have been in the news for their declining values, sparking investor concerns. We'll explore why these price drops occur and their broader implications. Our aim is to provide a framework for understanding these complexities. By the end, you'll be equipped to see beyond the headlines and understand the mechanics. So, grab a coffee, get comfortable, and let's get into it. We aim to demystify finance using simple language. We'll break down recent news and highlight what truly deserves your attention. This is about finding the signal amidst the noise, a crucial skill in investing. Let's embark on this journey into the debt markets. So, what exactly is a CLO equity fund? Let's break it down in simple terms so you can see why these funds are getting so much attention in the investment world. Picture a big basket, but instead of fruit, it's filled with loans made to large companies. These aren't your typical home mortgages, but rather loans to businesses across different sectors. These are called leveraged loans, and CLO managers go out and buy them from a wide range of industries. Think manufacturing, tech, healthcare, and more. The idea is to diversify. Spread the risk around, just like you wouldn't put all your eggs in one basket. By mixing loans from different companies and industries, the basket becomes less risky overall. But here's where it gets interesting. The manager slices this basket into different layers or tranches, each with its own level of risk and reward. The top slices are the safest. They get paid first when companies make their loan payments, but they also get the lowest interest rates because their risk is lower. At the very bottom is the equity slice. This is the riskiest piece, but it also has the potential for the highest returns, since it gets whatever's left over after everyone else is paid. CLO equity funds are designed to buy these bottom slices, giving investors a way to tap into high-risk, high-reward opportunities without having to buy an entire CLO themselves. The big draw: the potential for high income streams, since equity holders get paid from the interest collected on all those loans. If things go well, the payouts can be substantial. But there's a catch. If the companies that took out those loans start to struggle and can't pay, the equity slice is the first to take a hit. Defaults can quickly eat into the returns, and in a worst-case scenario, equity holders could lose their entire investment. That's the risk you take. If enough loans go bad, there might be nothing left for the equity investors at all. It's the classic high-risk, high-reward proposition, and it's not for the faint of heart. CLO equity funds let investors access this unique market, pooling money together to buy into these risky slices, rather than going it alone. But remember, if companies start defaulting, the cash flow to the equity holders shrinks fast, and losses can pile up quickly. The equity slice is always last in line for payments, making it the most vulnerable part of the structure. That's why understanding how CLO equity funds work and the risks involved is absolutely crucial before investing. Let's discuss the recent drop in CLO equity fund prices. Prices of these funds have declined, causing concern among investors. This drop occurs in the secondary market, driven by supply and demand. Investors might sell due to economic fears or market sentiment shifts. This herd mentality can drive prices down, unrelated to loan performance. The market price reflects investor mood, not the actual cash flow. A price drop indicates a change in investor sentiment about the future. It's crucial to distinguish between market opinion and actual cash generation. The price is a collective guess, not a reflection of loan performance. Understanding this distinction is vital for investors. The real focus should be on the cash flow health, not just price changes. This sets the stage for deeper insights into CLO investments. The market price drop of a CLO equity fund isn't the main concern. For long-term investors, daily price fluctuations are mostly noise. The real story is the cash flow, the lifeblood of the investment. Like owning an apartment, market value may fluctuate, but rent checks matter. CLO equity is similar. Share price is volatile, but cash flow is key. The success of your investment depends on total cash received, not market price. A price drop might be a buying opportunity if cash flows remain strong. The real risk is a permanent impairment of the cash-generating engine. This leads us to the bigger risks. The biggest risk in CLO equity investment is credit risk. This is the fundamental threat that can undermine the entire structure of a CLO, and it's the one investors must pay the most attention to. Credit risk is the possibility that companies who have borrowed money won't be able to repay their loans as promised. When a company defaults, it means they've failed to make their scheduled payments, and this can have a ripple effect throughout the CLO. Every single loan in the CLO's portfolio carries this risk, no matter how strong the company may seem at first glance. Even a well-diversified basket isn't immune. When defaults occur, they reduce the total cash pool available for CLO investors. This means less money is available to be distributed to all the different tranches, especially equity holders. The equity slice is designed to absorb these shocks first, acting as a buffer for the more senior tranches. But this also means equity investors are the most exposed to losses when defaults rise. If defaults pile up, the CLO's cash flow can be diverted away from equity holders and redirected to pay the senior tranches, which have priority in the payment structure. In extreme cases, this can shut off cash flow to equity holders completely, leaving them with little or nothing. The real concern for investors is the credit quality of the companies in the CLO's portfolio. Are these companies financially healthy and able to withstand economic stress? A wave of corporate defaults is the nightmare scenario for CLO equity investors, as it can quickly erode the value of their investment. This would severely impair the CLO's ability to generate cash, putting the entire investment at risk and potentially leading to a total loss for equity holders. Market price drops are just symptoms. The real disease is credit risk lurking beneath the surface. Investors should focus on the underlying health of the companies in the portfolio. Are they financially stable, with strong balance sheets and reliable cash flows? Are these companies operating in risky or volatile industries that are more likely to face challenges during economic downturns? A widespread economic downturn, such as a recession, could trigger a surge in defaults and put the entire CLO structure under stress. That's why understanding and monitoring credit risk is absolutely crucial for anyone investing in CLO equity. It's the key to protecting your investment and making informed decisions. Liquidity risk is another significant concern. Liquidity refers to how easily an asset can be sold without affecting its price. CLO loans are not publicly traded, making them less liquid. In a crisis, selling risky loans can be difficult, affecting the manager's ability to protect the portfolio. This risk extends to investors in CLO equity funds. The fund might struggle to sell its CLO equity positions at fair prices. During market panic, liquidity can dry up, causing permanent losses. Price drops hint at this deeper issue. Sellers accept lower prices for quick exits. The real danger is a market freeze, where the fund can't transact its holdings. This risk doesn't show up in daily prices, but is a fundamental market feature. Investors must be aware of liquidity risk when investing in CLO equity. Let's illustrate with a simple example that makes these concepts easy to understand, even if you're new to CLOs or finance in general. Imagine a CLO with two loans, one to a well-established, stable company and another to a fast-growing but riskier tech startup. These two companies represent very different risk profiles, but both are part of the same CLO portfolio. Both companies pay interest on their loans, which generates a steady stream of cash flow for the CLO, and ultimately for its investors. In scenario 1, let's say the overall market takes a hit and prices drop sharply. Investors might panic, but the actual cash flow from both companies remains stable and unchanged. The price drop is just market noise, temporary fluctuations that don't affect the real money coming in. The CLO continues to receive its expected payments. In scenario 2, however, the tech startup faces financial trouble and defaults on its loan. This event slashes the cash flow the CLO receives, creating a real and lasting impact. This is a genuine, permanent loss for investors, regardless of what the market price is doing at the time. The money simply isn't coming in anymore. The first scenario is all about market perception and investor sentiment, while the second scenario is about the underlying reality of the business and its ability to pay. Price drops are often temporary and can recover over time, but a drop in cash flow due to a default is permanent and much more serious. That's why investors should pay close attention to the possibility of scenario 2, where defaults can cause real damage. The real risk isn't in the daily ups and downs of the market, but in the financial health and balance sheets of the companies that owe money to the CLO. By understanding these two scenarios, investors can better navigate the unique risks of CLO equity and make more informed decisions. The focus should always be on the health of the cash flow, not just the ups and downs of market prices or short-term news. This example highlights why fundamental analysis, looking at the real numbers and business performance, is so important for CLO investors. Ultimately, investors must prioritize cash flow and company fundamentals over market sentiment if they want to manage risk effectively and succeed in the world of CLOs. When a company defaults, recovery is crucial. CLO loans are senior secured, giving lenders a claim on assets. The recovery process determines how much lenders get back. High recovery rates buffer CLOs from catastrophic losses. The performance of a CLO equity investment depends on defaults and recoveries. A good manager focuses on loans with high recovery potential. This process is slow and methodical, unlike daily trading. Investors should focus on corporate default and recovery rates. These numbers determine the final outcome, beyond market sentiment. Understanding defaults and recoveries is key to CLO equity investing. Let's wrap up by focusing on what truly matters. CLO equity fund price drops can be distracting. The real focus should be on cash flow over the investment's life. The health of the broader economy impacts corporate credit. A recession could spike corporate defaults, threatening cash distributions. Investors should monitor corporate health indicators. The specifics of the CLOs in your fund are crucial. Evaluate the CLO manager's track record and portfolio quality. Safety triggers indicate how close CLOs are to cash flow issues. Investing in CLO equity is about long-term corporate credit performance. Recent price drops reflect sentiment, not cash-generating ability. Focus on fundamental factors for informed investment decisions.